everyone, welcome to SFC Markets and Finance. After January FOMC meeting, the Fed showed it could soon raise interest rates for the first time since December 2018. At the same time, global growth has lowered since the fourth quarter of 2021. Is it a proper time for the Fed to hike rates? How will global economy perform in 2022? Will Asia drive the global growth again? Now we are inviting Paul Gruenwald, Global Chief Economist of S&P Global Ratings, to join our discussion. Hello, Paul. Glad to see you.
Yes, hello to everyone in Shanghai.
Since January, the Fed has become more hawkish. What did you learn from the latest FOMC meeting?
Well, the Fed Open Markets Committee released its meeting notes yesterday. And over the past few months, we've seen the Fed become more concerned about inflation. So as of yesterday, we now expect the Fed to begin to lift rates at its March meeting at least 3 times this year. And they'll continue to monitor the data into next year and beyond, but a clear change in course over the last few months from focusing on maximum employment, which the Fed says it has achieved, to more of a focus, again, on inflation.
It seems that the Fed will begin to hike rates in March. Is it too early to raise rates? Why?
Not too early. If anything, the Fed's probably a little bit late. They were focusing on what they call maximum employment. So they wanted to run the U.S. economy a little bit hot and generate a little bit of extra inflation in order to ensure that the expansion benefited as many people as possible. That's what they meant by maximum employment. But as we all know, the inflation stayed higher for longer, and the Fed has increasingly come to the view that there's a persistent part of the inflation story, and that required them to raise rates. So we would say, the Fed could have moved a little bit earlier, but now, again, they're clearly focused on trying to get inflation back down to the 2% target as soon as possible.
How many times will the Fed hike rates this year?
Well, it's going to depend on the data, but our current forecast is at least 3 hikes starting in March. One of the difficulties here is that when the Fed acts, it usually takes 2 to 4 quarters for the rate increase to have its full impact on economic activity. So the Fed is, in effect, changing policies now or close to now, and they won't know until early next year what the full effects of those policies are going to be. So that's one reason it's difficult to be a central banker. So the Fed is forecasting where they think the economy is going to be this time next year, and then they're setting their rates accordingly. But as of now, 3, and I would say the probability of more than 3 is greater than the probability of less than 3. So at least 3 is what we're saying for this year.
Will the Fed also reduce balance sheet in 2022? Why?
I think they're going to wait on that. They've been pretty clear about the ordering. What they wanted to do first is what we call finished tapering. So the Fed is still buying securities. They're still buying treasuries, and they're still buying mortgage-backed securities from the market. And the idea there is to, keep bond yields lower, and that's going to stimulate activity. They want to stop that first. So that's what they're calling tapering. They should achieve that goal by March. After tapering is completed, then they'll start to lift the policy rate, the Fed funds rate, which we just described. And then we think sometime next year, they're going to start this, bigger project of bringing the balance sheet back down to its normal size. We've done a little bit of work on that. That could take around a decade. That's a long process. The Fed's been expanding its balance sheet since late 2008. So that's a multi-year exercise, but we don't expect that to begin until 2023.
which will have a greater impact, hiking rates or reducing balance sheet?
The evidence suggests that it will be hiking rates. They're working on different parts of the financial system. So when the Fed raises the Fed funds rate, and Chairman Powell has said that is the main instrument for achieving the Fed's objectives. That one is impacting the very short end of the curve, and that's the rate at which banks buy and sell dollars to each other. The QE, or the balance sheet operations, are operating at the longer end of the curve, 5-year and 10-year treasuries. So the current thinking is that the bigger impact is going to be on the Fed funds rate, which is why the Fed is going to be moving on that instrument before they begin to move on normalizing or reducing the balance sheet.
If the Fed tightens its policy too quickly, will this cause the recession?
There is a risk that the Fed will tighten policy too much, and that's because, as I said earlier, they have to wait 1 year to see the impact. So there's a small, growing group of economists who are cautioning the Fed not to move too quickly. What the Fed does not want to do is start tightening, and then the economy slows too much and then have to reverse those measures. In terms of a recession, we really don't see a very high risk of recession. If we think of recession as 2 consecutive negative quarters of growth, our current U.S. team has a probability of 10 to 15%, which is actually quite low. So the risk there is more about slowing growth. U.S. growth should be 3.5% to 4% this year, which is still quite good. But the risk there is that the recovery slows down rather than having a recession. A recession of negative growth seems pretty low probability at this point.
Once the Fed begins to hike rates, how will the Fed action affect other countries?
It depends on the country, right? So if you're a big economy like Europe or China, you probably don't feel too much of an impact from the Fed. But if you're a smaller country, maybe your government is borrowing in US dollars and your borrowing costs are going to rise, or maybe you're dependent on capital inflows from the rest of the world, and the Fed tightening rates might slow or reverse those flows. Those are the kinds of countries that are paying very close attention to the Fed, and maybe starting to lift rates themselves to protect their economy. But it's certainly not everyone. Again, the larger economies will see less of an impact, but the smaller, more open ones, more financially dependent ones, those would be higher risk in our view of having some spillover from the Fed move to their economies.
What should the emerging markets do to avoid the taper tantrum?
Right. Well, the taper tantrum, for your listeners, happened about 10 years ago when the Fed announced that they were going to start to lift rates. And then we saw an enormous shift in capital flows. We saw markets really move to what we call a risk-off mode. So there was a flight to risky assets, mainly U.S. Treasuries, and there were 5 countries called the Fragile Five by one of the investment banks, and they took the biggest hit. 2 of those are in Asia. One was India, another was Indonesia. Well, one thing we could do this time around to make sure those impacts are managed better is to be transparent and announce in advance, not necessarily when we're going to move, but what the thinking is about raising rates and normalizing monetary conditions. We tend to see market moves, big market moves, when the market is surprised, and then they have to reprice the path of Fed funds rates, or reprice the path of U.S. interest rates more generally, or reprice the path for the U.S. dollar. And when markets have to reprice assets, that's when you see these big adjustments. So that's why we generally think transparency is good. the Fed and other central banks share their thinking, and then they're kind of managing the market expectations and the market prices. So that makes the surprises relatively small. Big surprises generate big disruptive capital flows, and that's something we generally want to avoid.
The COVID-19 pandemic has lasted for 3 years. Will the pandemic still be the key factor of global growth?
Well, we hope not, right? The pandemic has caused enormous economic damage. It's caused damage to employment. It's caused damage to people's well-being. I think the good news is as we go through the pandemic for COVID, it seems like each successive wave has a smaller economic impact. So Delta over the summer last year had a smaller impact than Alpha, which was the first wave. And it looks like Omicron, at least in terms of the economic impact, is having a smaller impact than Delta. So part of this is the virus itself is less deadly. So we see, fewer people in hospitals and smaller disruption to work. But also governments are getting used to managing, right? So do you lock down or not lock down? Certain sectors are closed for health reasons, such as, restaurants and large events, but the rest of the economy remains open. So hopefully as we go into 2023 and beyond, COVID becomes less of an economic issue, certainly less of a health issue. And we converge to something that looks like the seasonal flu, which we all know. We're not. My team is economists. We're not medical experts, but we're hoping and forecasting that these successive waves of COVID have less damage in terms of health and economics. So that means as a forecaster, we're paying a little bit less attention to the pandemic and more to traditional economic variables. Hopefully that's going to be the case this year and beyond.
Global growth has softened since the last quarter of 2021. Will global economy keep growing in 2022? Any potential risks?
Yeah, well, first of all, last year was an exceptional year for global growth. That's because we were recovering from the pandemic. So we all know that 2020 was quite bad. So it was natural to expect high rates of growth last year. Just as an example, the US looks like about 5.5% growth, Europe over 5%. And the global economy, everything together, was probably 5.7% more or less. So these are well above the trend growth rate. So this year will be a bit slower. What we're forecasting over the next few years is essentially getting back to normal. So 2022 will be slower than last year, and then 2023 will be slower than this year. But we're forecasting the global economy and most economies to be frank, to go back to their trend growth rates, which is about 3.25%, 3.5% for the global economy, 2% for the US, a bit less than 2% for Europe, and then China close to 5%. That's kind of a new growth objective for the government. But we're going to see slower growth rates, but that's to be expected. What we're really looking at is whether economies can get back onto their pre-COVID path, right? So COVID was a massive disruption. Can economies, through policy and through using markets, et cetera, get back on their pre-COVID paths? It looks like most of the advanced countries and China will get back to their pre-COVID paths, but for a large number of emerging markets, they may be on a permanently lower path. So that suggests some lasting damage from COVID. That all remains to be seen, but again, it looks like the advanced countries in China will get back on their pre-COVID path.
In your 2022 Outlook report, you mentioned that the rising inflation fears overshadow a robust rebound. Most views showed that the inflation will fall this year. What's your prediction?
Yeah, well, we're in a pretty good recovery. If you asked me last year, which you did, what the world would look like in 2021, we were expecting a strong rebound, but we raised our growth forecast several times last year. So inflation is coming on the back of a very strong, I would say, unexpectedly strong global rebound from COVID. So in a sense, it's a good problem to have. But as we discussed earlier, inflation is running higher and for longer than the Fed and many other central banks expected. So they are either raising policy rates now or about to raise policy rates soon. And that's going to slow the growth trajectory down. But again, that's not necessarily a negative development because the recovery from COVID has been stronger and faster than we thought. So it's still a good story. It's still a good macro story, but inflation is a bigger issue than we thought, and it's become the near-term policy focus for most central banks.
How do you think about the global economy in 2022?
Global economies in again pretty good shape this year. There's still a lot of variation. There's a lot of variation across countries, and there's a lot of variation across sectors. So again, we've seen a pretty good rebound in U.S. Europe in particular has been doing well over the last 6 months, and then China was the first country to recover, and Asia's doing pretty well. But we still have a lot of emerging markets that are struggling to get back to their pre-COVID level of GDP. So what we're doing is looking at countries' level of GDP compared with the end of 2019, which is right before the pandemic started. And we still have a number of countries that have not gotten back to that level. And now we're 2 years later. So we're trying to gauge whether they can actually get back to their path. And again, number of countries are going to struggle. Probably the most important one in Asia is India. Our team in India thinks there could be a permanent output loss of up to 10% of GDP in India. So again, the recovery is good, and then sectors as well. We've seen some sectors like durable goods, and we know about all the pressure on supply chains for electronics and automobiles and other things. Those sectors have come back very strongly over the last year or so, but we know some of the services sectors, food and beverage and entertainment, tourism, cruise industry, etc., they're still struggling to come back. So the big general picture is good, but we still have both countries and sectors that still haven't fully recovered from COVID, and we expect that to continue into 2022 and 2023.
How are supply chain developments in Asia affecting the global inflation outlook?
Well, they have a big effect, right? Because Asia, centered on production in China, is properly called the warehouse of the world. So a lot of consumer goods and durable goods are produced in Asia's very sophisticated supply chains, and then some is consumed in Asia, some is sent to the U.S., and some is sent to Europe. What we learned over the last year or so is that although these supply chains are very efficient, right, they were built to scale with very low inventories, very precise, logistics and everything. These very efficient supply chains are actually not very resilient. So COVID was a shock to the global economy, and COVID was also a shock to supply chains. But as we recovered and we had a big rise in the demand for durable goods, again, electronics and automobiles, for example, and then we had some, issues around people and ports opening because of the pandemic. When we put all that together, the supply chains got very disrupted. So we know about the backlogs, we know about the inventory rebuilding, we know about some of the problems at the ports, including here in the US on the West Coast. So this has been driving inflation, right? One of the 3 drivers of inflation has been supply chain related costs. The other one is energy, and the third one is just old-fashioned domestic inflation. But this supply chain congestion has been driving some of the inflation. Our analysts on the ground in Asia and elsewhere see some improvement. It looks like delivery times are starting to fall. Some of the backlogs are starting to fall, but it's going to be a couple of more quarters at least, well into 2022, maybe 2023 before we get back to normal. But I think the trend here is improving. It looks like the worst is hopefully behind us, and the supply chain metrics are starting to improve. So as a source of inflation, it's probably not going to be a big driver this year, but we have unhappy consumers who have to wait for their stuff, and we have some of the producers in the supply chain are doing quite well because their order books are full. But the whole system, that very efficient system that was constructed, has not returned to pre-COVID normal functioning. That's going to take a bit longer.
Will Asia become a global economic powerhouse this year?
Well, Asia already is an economic powerhouse, so I guess the question is whether it's going to continue. And I think that's a reasonable assumption, right? So we know that China alone has been responsible for about 1/3 of global growth over the last few decades. So global growth again has been around 3.25%, 3.5%. And more than 1 percentage point of that, or around 1/3, has been coming from China by itself. And then, when we add some of the other smaller but fast-growing economies in Asia, Asia has a very outsized contribution to global growth. So there's really no reason to expect a big change in that in 2022. I do think a couple of things are important to watch. One is that growth in Asia, including China, has been very export dependent and manufacturing dependent over the last couple of years. So we're seeing these trade surpluses and current account surpluses emerge again. That just means, in one sense, that Asia is benefiting from strong consumer demand in the U.S. and Europe. We would want to see more consumer demand coming from inside of Asia. So I think that's one challenge. And then the other challenge is going to be the supply chains. I think when we have COVID behind us and when we start to take stock of lessons from COVID, supply chains are going to be re-examined. As I said earlier, supply chains are very efficient, but they failed the test of resiliency. They didn't respond very well to the shock. So does that mean higher inventories? Does that mean, more geographic spreading around, maybe shorter supply chains closer to the home country? What does it mean for inventories? What does it mean for ports? What does it mean for other things? So Asia's been a huge beneficiary of globalization, and globalization's not going into reverse, but I think supply chains are going to be re-examined as we exit COVID. So, subject to generating more internal demand and subject to how supply chains come out, I think Asia's future is still pretty bright.
All right, thanks, Paul. Thanks for your time. As Paul said, it's not early for the Fed to begin to hike rates in March, since the U.S. labor market was near pre-pandemic rates. Additionally, global economy will keep steady growth this year. That's all for today's show. See you.